using paper and pen, not the computer, because obviously the computer will, the computerized portion of homework that you're doing does look different because you're not, of course, writing anything. You're kind of filling in the blanks as you go. But if you're really wanting to get the grasp of what's happening, you're going to have to stop probably and maybe do one by hand. And so 4B is one that's really good. Again, it kind of brings all the pieces to the puzzle into one place. And I'm going to send you the solution so that once you attempt it, you'll have immediate feedback to check yourself. That's the other thing in accounting. Sometimes you just need that immediate feedback, which is why I do like the homework, the way it's done. It kind of gives you that immediate feedback. But anyway, I will send that through the messaging part of Blackboard as soon as class is over, because I do have it scanned, and I completely forgot that I had that, which might help some of you. So, but right now, let's just kind of pull the pieces together on a visual here, kind of getting started, recapping chapters 1 through 4. If I can get mine. Here we go. In chapter 1, of course, we talked about that there's just a lot of random information in chapter 1, and it's nothing that you shouldn't be able to grasp on your own. Chapter 2 introduced the fundamental accounting equation, which started and completes everything that we do. Assets equal liabilities plus owner's equity, and it is a first, second grade math equation. That's all it is. And so, as you can see, if you're going to manipulate one side of that equation, you're going to have to manipulate the other to keep it in balance. And that's why we say in accounting, our books, our records, financial records are always in balance, because we know what we own, which is our assets, we know what we owe, which are our liabilities, and the leftovers are ours. There's no magical number up there that says owner's equity, or that is owner's equity. It's nothing that we can put our fingers on. It's nothing that we can touch, see, or feel, or walk out and put it in the file cabinet and say, that's my owner's equity. Why not? It's fluid. It changes all the time. Depending on how many assets you have, and depending on how much you owe, your owner's equity could change several times during the day. How could that be? It could be because we're taking cash, which is an asset, and we're paying, maybe this afternoon we're going to pay bills, and so we may be paying on 5 different liabilities. Every time we make a payment on one of those liabilities, our assets are affected, our liabilities are affected, and then ultimately our owner's equity changes because it's a plug number. And if our liabilities go down to 0, then all of a sudden, then everything that we own is ours. Because remember, this side of the equation is ownership. Ownership of the assets. And that's really all this equation is. What do we own? Who owns it? And there's always 2 people that own it. Us, the owners, but first and foremost, the creditors. They're an owner as well. And so when this was developed then, we had to figure out a way other than this equation to keep track of things, because this does not tell us everything that we need to know. We need to know what kind of assets do we have, who do we owe as far as the liability is concerned, and then of course, this owner's equity account over here is really nothing to concern yourself with unless you're initially opening a business and you're depositing equity into your business, or at the end of the year when we are, and we won't get into this until chapter 6, when we're actually dumping the revenues and expenses back into the permanent owner's equity. Because revenues and expenses are ours. We create revenues or we spend our money, one or the other, but it is ours. Okay, so this is, again, the fundamental of everything that we do. And it really is very much of a simple first grade equation, but we had to develop it to keep track of things very specifically. What assets do we own? what liabilities do we owe, and then depending on the formation of your company, in this class, we're only dealing with a sole proprietorship, so we're dealing with John or Jane's equity, and that's all we're really keeping track of. So, in our cycle of keeping track of or entering into our system, we will always enter into a journal. That's always rule number one, so to speak. In other words, this is where we're going to describe the who's, the what's, and the when's of a particular transaction. And again, in a manual system, we will have a journal entry for every one transaction that happens in our business, for every one financial transaction. A journal in this class, we're actually using what we call a general journal, meaning it's very general. We're going to put every single transaction that happens into this particular page, and you have to kind of visualize this truly is a page of paper that we're simply just creating some columns here. Whereby we're going to have a date column, because that's very important to keep track of in a transaction. A description as far as what accounts were affected. That's the whole purpose of the journal. We know the transaction happened, but we don't know maybe at that particular point in time, well, what accounts were really affected because of this transaction. And then we have a post-referencing column that we'll talk about in just a second. And then we have a debit column and a credit column. And if you are thinking of these as anything except left and right, then of course, as we've said, you're just messing with your brain, because that's all they are. And so I'm going to, if you have a book or have your electronic book open, just to give me some numbers to go off with. I'm going to enter a couple of transactions here, and this is from 4A, exercise 4A. If you haven't figured this out at the end of your book, there's two series of exercises, what we call the A exercises and the B exercises, and they're really very redundant. They go over the very same things. It just gives you two opportunities to have some more numbers. But in 4A, it gave you a bunch of information for Diane Burnick. She's got a consulting firm. They gave you a list of accounts that are going to be affected in these transactions, and then started giving you the transactions. And then that's your job as the accountant to describe, or excuse me, to enter them into the journal and update the ledger so that we make sure all of our accounts are accurate. So in your mind, you could be thinking, well, someone just handed us the bank statement for January for Diane. Those are our transactions, aren't they? A bank account is full of transactions, isn't it? Well, depending on the company, but sometimes bank statements are 3-4 pages. And every one of those is a transaction that needs to be recorded and updated in our system. So it says on January 1st, Diane invested money in the business, or cash in the business, $12,000. So every transaction, and this is always going to be, as far as y'all are concerned in this class, the first transaction is always going to be this. Someone's got to get money into a business checking account, so to speak. And so we know it was January the 1st, and we need to describe in this transaction for Diane, what accounts did she affect when she did this? What accounts were affected in our fundamental accounting equation, assets equal liabilities plus owner's equity? And we have basically cash. They told you that. She put some cash in the business. Well, of course, we know that she probably went to the bank and put it into a bank account so that she'll have it to be able to access it, excuse me, as needed. But her bank account or her cash just increased, didn't it? Everybody get that part. Her bank account increased. Okay? We need to reflect that in this particular journal entry on January 1st, that on this day, her cash went up. Cash is what kind of an account? That should be your next thought process. Okay, cash went up. Well, what kind of an account is cash? And it's got to be one of these three. It's an asset. If it's in her bank, she owns it, doesn't she? That doesn't mean that she doesn't have any liabilities. It just means that particular account belongs to her. So all assets, as we learn the rules of debits and credits, and I'm going to give you what I call my little simplified cheat sheet of rules of debits and credits. A, E, D, and L, O, R. What do you think I've just done?
Assets, equity, debit, credit, owner's equity, and
Revenue?
Yep. But it's really assets, expenses, and the drawing account. And I'm not saying that assets are expenses or expenses are drawing. I'm not saying that any one of these, the AEDs, are substitutes for the others. That makes sense? I'm just saying that these three kinds of accounts follow the same rules of debits and credits. In other words, they're going to increase on the debit side and decrease on the credit side. Why? Because all three of these guys have normal debit balances. Okay? But LORs are the other three accounts in our primary system: liabilities, owner's equities, and revenues. They all follow the same rules. They all have a debit side and a credit side, but these guys have normal credit balances, so they increase on the credit side and decrease on the debit side. So that's just my little cheat sheet that I always use for rules of debits and credits when I was first getting accustomed to them. Eventually it'll be second nature to you. You won't even have to think about it if you work with it enough. Anyone in here an accounting major by chance? One, two? Okay. Anyway, these are your rules of debits and credits, and they'll follow you throughout the highest accounting class you'll ever encounter. It never changes. Okay? So let's go back then to our transaction for Diane on January 1st. We just said cash was affected. And cash, if she put it into the business, and we're talking about the business set of books here, not Diane personally over here, but we're talking about Diane over here in her business office. She just put $12,000 into a business checking account. And we already said that cash is an asset. Her cash account just went up, didn't it? Any asset, I don't care if it's cash, furniture, automobile, any asset that we own will go up on the debit side, period. I don't care what you think about that. That's what's going to happen. And so I'm going to indicate in my description column that cash was affected. And then I'm going to describe by how much and in what column do I want cash to be affected. And I just said that cash went up in this transaction, so I will enter $12,000 in the debit column, so that my reader, or that I don't forget on January 1st, that's what happened to cash. It's really for the accountant's benefit in the journal, so that they can track everything that they have recorded into company's books. And this is the first book. We say book because there are more than one. There is more than one, rather. Okay? What happens if I just stop there and say, okay, I've updated cash. I've taken care of the cash side. What? It's not balanced. I entered a debit, but my rule says at all times, because my fundamental accounting equation is just basically a picture of debit equal credit, left equals right. I have only entered on the left. I better find something that is credited or entered on the right. And we just said that, of course, she made her cash go up. Does it say she borrowed it?
No.
Nope. So whose cash is it? Hers. It's hers. And it did not say that she earned it, so we don't need to separate that part of her equity right now because of revenues and tax ability and all that stuff. This is just simply her moving money from personal over here to business over here. So we will increase Diane's owner's equity. And owner's equity always, and it went up because she moved it into the business, and it says, my rule says owner's equity goes up on the credit side. Well, lo and behold, that's what I need to balance this increase. And so I will enter $12,000 on the credit side. And then in true accounting form, we should put some kind of description, and even in QuickBooks or any computerized system or manual system, you should indicate to record the deposit of maybe check number so-and-so and so-and-so from Diane to open a business checking account. That description is just to mentally remember maybe first of all, where did the money come from? Maybe the check number involved. Accountants are very, very detailed people. They keep track of all kinds of different things that sometimes some people don't consider financial, but they are. And without good accounting records, how can you track things back to their original thing after 20 years? Agreed? You know, the FBI employs a tremendous amount, and probably accountants and attorneys are two of their highest number of hires. It's not necessarily, you know, police officers or not that the accountants and FBI. Mm-hmm. They are constantly, that's typically one of the first ways criminals are entrapped. I don't want to say entrapped, that's not a good word. That's the first way that they are kind of detected is usually through monetary mess-ups.
RICO?
Huh?
RICO.
What's that?
Federal statute, that's how they get a lot of them off.
Oh, I don't know that. All I know is that there's lots of accountants out there that work for the FBI, and all they do is try to detect, or do detect, fraud in people's books. Well, it's really easy to detect, or not easy, it's easier to detect if they walk into someone's business where they've had a really good accountant. What do you think? Because a really good accountant is doing what? They're keeping very good track, and they're making their trail very specific. So like right here, they would say, Diane contributed money from her personal account with her personal check number 102, coming from Amarillo National Bank or something like that, and now we're depositing it into Lubbock National Bank, account number so-and-so and so-and-so. So a really good accountant is very detail-oriented, and that's where the journal comes in. The journal is where we're going to keep track of the little bitty specifics that aren't necessarily number-oriented, so to speak. That's not what you're concerned about right now. You're concerned about the process and how are we entering equal debits and credits. But the journal is a place, it's just like it describes, a journal, just like a diary, is a place that you record things you don't want to forget, right? That's all a journal really is. But our journal in accounting is going to be just a little bit different. We're going to record dates, and we're going to do it in chronological order, and we're going to record things that we don't want to forget. But our primary goal is to record every individual transaction and the accounts affected and the amount. So once January 1st is over, it's over on that particular transaction. Okay? And we go to the next transaction. So I'm going to do just a few here, then we're going to just put the full picture into play. And I might try to well, let me see if I can find something else that you can actually read. I know my handwriting is very difficult. Let's go down to January 11th on 4A, and it says that Diane purchased office supplies on account. So you got to also, at this point, hopefully you're getting familiar with the language of accounting. It's definitely a whole different language. When we say we purchased on account, what does that mean, really?
You have credit with someone.
Okay, without using those words, tell me something else. Without using the word credit.
You promised to pay at a later date.
Right? We had bought something, but we have promised to pay at a later date. Well, that's the definition of what? Promise to pay later is the definition of one of the three accounts in our system right here. Which one is it?
A credit card.
A liability. The promise to pay in the future is a liability. And so if Diane just bought some office equipment or office supplies on account for $250, what they're saying is that Diane bought the supplies. She's going to walk out the door of the store or wherever with the supplies, but what is she promising to do down the road? When she bought it on account.
Pay it off.
She's promising to pay down the road, didn't she? Hold on, I'm trying to... get to this document that tell me there's no documents. I really just kind of detest computers sometimes.
Mm-hmm.
Because all I want to do is go to my... Okay, I'll get back there in just a second. Okay, so she bought the supplies. Supplies in this class is an asset. So supplies, she just bought them, she just walked out the door with them, her supplies just went up. Everybody agree with that? And all assets, according to my rules of debits and credits, if I just walked out with them and I have more today than yesterday, my assets just went up, didn't they? And I want to keep track of supplies, specifically. And assets go up on the debit side. So I will record a $250 amount in the debit column next to supplies. Remember, these are, you can't tell it in my stuff, but they're all going horizontally. And she just promised to pay, therefore she now has a new liability, doesn't she? She owes someone $250 for these supplies. Therefore, her liabilities have increased. Everybody agree with that? Liabilities go up on the credit side. Well, lo and behold, again, that's exactly what I need to balance this journal entry. So I will credit A/P standing for accounts payable. Yes?
Every time you input something, do you have to start with the debit, or is that just to make it look nice, or do you have to?
It's a visual thing. Left comes before right. It's kind of like reading, left to right. You don't have to. It's just a habit I have, so you'll always see me do that because I'm a very old-fashioned accountant. I can't get into my documents. I've never had that issue before. Hold on, give me one more chance here. Okay, so while this is loading and me trying to find this file, I hope that the number one thing that by now that you kind of grasp is that for every one transaction, at least how many accounts, just look at this, how many accounts are affected for every one single transaction? 2. A minimum of 2. You can't buy supplies and just only affect supplies. Because somehow you paid for them. If I don't record maybe we paid cash for them, what if I don't record that part of it?
They don't just come out of thin air.
Yeah, exactly. And so if I fail to record the cash side of that, if she had paid cash, and I don't record the fact that cash just went down, what eventually is going to happen to my cash account?
Overdrawn.
Yeah. Why?
Because you won't realize your balance when you will go out, make a purchase.
Yeah. Because if I'm not reducing my cash every time I use it, then I don't have an accurate cash balance if I go to look into my system. Everybody agree with that? Kinda? Okay, I'm going to show you what I'm going to be sending you through your messaging. This will help us go a little bit faster here and maybe be a little bit easier to read. I don't think I can enlarge it, so hopefully y'all can see that. But this is problem 4B, and you can see I have gone through and entered every transaction into the journal. This is not going to be any different than what you're going to see on the test or what you've been seeing in your homework. The only difference is, of course, that I did it by hand, on paper and pen. But the book in your homework, it gives you options to choose from for the account to debit or the account to credit. Have y'all already realized that?
Mm-hmm.
And then it's going to give you an option of what column to record it in, the debit or the credit side. So that's where it's testing you. Do you know enough to know what you're doing? So let's just look at a couple of these transactions. On the 9th, this was for a bicycle repair shop, and on the 9th, I can't remember whose company it was, Ricky or somebody, performed services. He repaired some bicycles for cash. Well, what did Ricky get? He got cash in exchange for services. He performed. So it's his money, is it not? Yeah. He didn't borrow it. He doesn't have to take it back and give it back to the customer at some point in the future. He earned that money. So theoretically, if you can see here on the 9th, where my mouse is right there, I don't think. On the 9th, he deposited the cash, therefore cash was increased with a debit for $140. And why didn't we just go ahead and credit owner's equity right there instead of repair fees? Because we just said it's his money. Why did I choose repair fees, which they gave you a chart of account, and fees in this class means a revenue? Why did I credit a revenue there instead of, again, Ricky's owner's equity or whoever it is?
It's more specific, and it will show where and how exactly he gained that income. I was just now thinking about this. Let's just say a farmer, well, you have your cash crop, you sell it. What if you finish harvesting by November 22nd, but your neighbor desperately needs help? He may hire you out for harvest,
Mm-hmm.
and you go over there and help him. He'll pay. Well, you have gained income, but it's a different type. It's not personal income. I mean, it's not your business's income for your sales.
And that's why accountants are very specific as to exactly what kind of revenue or what kind of income where did this come from? Well, here we know very specifically that Ricky got hold of this money because he did what? He repaired something. Agreed? And I know it was bicycles, because I've done this problem a million times. Ricky repaired a bicycle, and someone paid him $140. Well, what if Ricky had repaired a motorcycle? Then he might want to keep that in another account so that he can see where are his primary revenues coming from repairing bicycles, motorcycles, or maybe renting a bicycle, renting a motorcycle. You know, there's all kinds of different revenue streams that companies will encounter during their business life. And a good accountant is telling you where you earned that sum of money. And the main reason we put it into repair fees versus his owner's equity is because repair fees are taxable. Revenues are taxable. Just simply moving money from Ricky's personal into his business account is not a taxable event. Well, yet. I mean, this will be the year if it happens.
Yeah.
So, anyway, you following me? Revenues are taxable. And we need to separate them during the year because we're only going to pay tax on them one time. But it is Ricky's equity. But the main thing is that you can see here the difference between repairing for cash, and I don't think this problem, the only thing I didn't like about this problem was it never gave you the opportunity to record the event if Ricky repaired on account. What if it had said that Ricky repaired Jane's bicycle for $140 and she promised to pay him, or he performed on account. Now what does that mean in respect to, here we debited cash, but if it said he repaired Jane's bike on account, now what do you need to be recording?
Would it be, that's where I get confused, would it be fees earned or, fees earned or, I can't think of it right now.
He did earn the fees. You're right on that part. And that's what, right here, the credit, I wish I could change the color here. I don't think I can. But right
Oh,
here,
that one would be
the credit
fees
to
earned.
repair fees is the revenue. What is the only thing that's going to change, because he didn't get cash. So I've got to have a debit in the transaction, don't I?
Mm-hmm.
Accounts receivable?
Accounts receivable.
Oh, that's what it was.
Yeah. So accounts receivable is an asset. It is not a revenue account. So be very careful. Accounts receivable is recording the fact that he did not get cash of $140. If we put in there accounts receivable, that means that Jane has promised to pay him down the road.
Mm-hmm.
And he doesn't want to forget it, does he? That's again why cash may not have changed hands, but why would I want to record transactions that don't involve cash? I mean, that's the obvious, isn't it, that we want to just keep track of our cash all the time?
How's that quarter going to turn out for you as far as profits? It might keep it track sort of where you're gonna be headed at the end of that quarter.
Right. I mean, the main thing is that there's lots of things that happen in a business that cash is not involved. Cash is about 90% of all transactions, but there's that huge 10%, 20% of a business that is done on account. Either we're buying on account or we are earning on account. And so you've got to get used to the language of an accountant. Okay? And if you've ever worked in an office setting, you may have already kind of been acquainted with that terminology and you're a little bit more familiar with it. But if not, you do have to kind of focus on how do business people talk? How do accountants talk? And they use expressions very effortlessly, thinking everybody knows what I'm talking about. Okay? And unfortunately, not everyone does know. Okay, let's skip down here to wages on the 14th of this month. He paid some of his employees some wages totaling $300. What do you pay your employees with? What do you give them? Cash. They're not working for anything else, I guarantee you. So he had to write a check. That would have been his credit, right? Credit to cash, because cash just went down. But he used it, he wants to keep track of this in an expense account because it is a legitimate business expense, to pay wages. Therefore, expenses go up on the debit side, so that fits that particular event. Debit wage expense, credit cash. Okay? Let's see. Drawing, we haven't talked about that one a lot lately. This is on October 23rd, Ricky took some money out to maybe go out to eat, you know, go have a nice time, go on a date, we don't know. But that has nothing to do with the bicycle repair shop.
No, his monthly personal expenses.
Right. He may do it monthly, he may do it weekly, he may do it just very randomly. We don't have any control over that. But in our grand scheme of accounts, drawing is an equity account all by itself that records and updates every time the owner takes money out for personal use. It has a normal debit balance, so every time an owner takes money out for personal use, that account goes up, and it goes up with debit. So you can see we debited drawing for $50, and he took cash out of his bank. We had to credit cash for $50, a debit and a credit. And then the next one I did want to go over right quick before we look at the rest of it. October 25th, this is what it said as far as the language is concerned. Again, if nothing else, this is a good problem for you to go through and read the language in the descriptions of the transactions so that you can then kind of figure out, well, what are they talking about? So it said on the 25th, all it said was that Ricky made payment on account, $50. So what does that mean? The owner made payment on account. We have to kind of break up the sentence. First of all, made payment. What does that mean?
He paid cash.
He paid cash. When you make a payment, you're obviously sending some money to someone for something. Made payment. So you can see here the credit to cash, $50. So I need a debit. What did he do? It says made payment on account. Well, what does that mean? Accounts payable. Because he owed somebody. Why else would he be sending somebody some money? Agreed? He obviously owed someone money. What do we call that? We call that a liability. And liabilities go down on the debit side. Again, your rules are just vitally important. That you understand liabilities go down on the debit side. So I debited accounts payable and credited cash. So again, go through all these transactions, get yourself some 2-column paper. It's very easy to Google. It's everywhere, 2-column general journal pages. There's free templates out there everywhere. And do those journal entries. And then what is this right here? This will be part of your solution that you're going to be getting.
Overview, yeah.
Which resembles or mimics what? They're only used really in educational purposes. No one keeps track of things in T's in real life. But if I were to put all of these T's together, and there's a whole page of them here, all of those T's on their each separate page, if I were to bind them together and staple them or put them in a notebook or whatever, what do they become? What phrase have you learned in chapter 4 or chapter 3 and 4 that tells you what that would be? The first one was the general journal, a 2-column paper where we're just recording journal entries. Once I go and start updating accounts, this is my general ledger. Very good. All accounts bound together to prove that debits equal credits is a general ledger. That's where your that's where your set of books comes from. 2 books. The general journal, which is up here, if you can visualize that you'd have page after page after page, all bound together somehow. And all of those get entered, the dollar amounts get entered into the accounts that the journal told us to debit or credit. We didn't have to think at this point. When we're moving the debits and credits to the accounts affected, it's because the journal has already told us cash was debited and cash was credited on this transaction, whatever the case may be. And then all these accounts, in just a second, you're going to see how we prove that the debits entered into the accounts equal the credits entered into the accounts. So let's go back to the very first journal entry. What did Ricky do? He put cash into his business. Agreed? And I've already told you that's going to be the first transaction for almost 99% of all businesses. They're moving cash into a checking account because it's really hard to do business without some kind of a bank account. So cash was debited and capital or owner's equity was credited. Any questions on that particular journal entry? Because cash went up and equity went up when John or Ricky or whoever it was started his business. So to post that to the journal ledger, because this is just the journal, nowhere, I want you to, somebody answer just quickly. Looking at this page of journal entries and all the numbers I've got written here, can anyone tell me real quick, what's the amount of cash when October was over for Ricky? I'm flipping the page for you. Tell me, quick. You can't tell me, can you? That's not the intent of the journal. What is the journal intent? What is its purpose? To keep track of every individual transaction by date. It's not keeping track of the balances, because what if this were like year 5 of Ricky being in business? We have no idea what's in the general ledger before this, or in the accounts before this month happened. So where am I going to find account balances? In the 2 books. Where would I find them? The general ledger. And how do they get from here, the journal, into the ledger? I say this is called entering into the journal, but I tell y'all last week the phrase was when we update our account. Posting. I take the journal entries and I take every single debit, every single credit, and I post it or transfer it to the account that it named for the amount that it told me and for the debit or credit. So let's look at the very first transaction here. Cash was debited, capital or owner's equity was credited. So I'm going to go down here to my general ledger. I'm going to find cash. What do you see is the very first amount on the debit side, where my cursor is? You see a $15,000 amount on the debit side, don't you? And if I had been a really good accountant, which I wasn't in this particular instance, I would have said what journal page that had come from. I better have a credit somewhere else in another general ledger account. What do we say in that journal entry? Debit cash, credit owner's equity, right? We'll look over here at, and I've got it labeled capital, and I've told y'all that I never do that, but I did it just because the book kept reinforcing that word capital, but it's owner's equity, same thing. I've got $15,000 on the credit side. Everybody see that? So when I posted to the ledger, I debited cash for $15 and I credited capital for $15. Wasn't any different than the journal entry. So what's the whole thing? Why do I have to do this 4 freaking times? Because the journal told me what? The date, maybe possibly where it came from. In other words, the journal did nothing more than tell me the events on January 1st, which included a $15,000 deposit into the bank account to start the business account. What is the general ledger telling me here? I mean, look here at the end of October, all of these transactions that I have debited and credited to cash, where did they come from? From the journal. And so now I can say at the end of October, or whatever month this was, the bicycle shop has a $14,539 debit balance. And I only could come to that because I took every transaction from the journal that affected cash and entered the same debit or credit to the cash account. And I have to do that for every single account. Then I checked myself to make sure what?
Debits or credit?
Yes, debits equal credit. So how am I gonna do that? With a little, thing called the trial balance. And all I've done here is I've listed all the accounts from my general ledger and their respective balance that I just computed after posting all the transactions from the journal and posting them into the specific ledger accounts. And look here, my debit equal my credit. And I can tell you every single account by the end of this month, I had the cash of $14,500, I had office supplies of $250, I had paid wages totaling $600. All these things had transpired and had accumulated by the end of this month. If this does not balance, then you've done something wrong. You either entered amounts as a debit twice possibly, or transposed them. All kinds of errors can happen. Like we talked about last week, computers made accounting what it is today in that it can't think, it can't tell you what the transaction debit and credit should be, but what does it do perfectly? What does a computer do perfectly? A very, very simple function. What does it do? It can add and subtract perfectly, can it? If it's programmed to add this column, or to add this column, or that column, you can trust a computer that as long as it was like Excel or, a legitimate computer program, it can add very easily, can it? But we could have maybe misadded just in my T accounts when I was, putting them, and that could be what was causing it to be out of balance. So computers took at least that step away from the accountant having to be perfect in their addition and subtraction and making those kinds of errors. Then from this trial balance, I can proceed to prepare all of my financial statements. And they're done in very specific order. The income statement, the statement of retained earnings, and the balance sheet. And we do them in a specific order because one uses the other. So again, I'm going to be sending this to you. Go through this because it really is pretty helpful to see how do I take the trial balance. Because if I handed this to Ricky, the bicycle shop owner, he'd look at it and say, oh, that looks good. Doesn't mean a hill of beans to him, though, at this point. What does he want to see? He wants to know, how much should I make this month? Has my equity gone up or has it gone down since I started my business? And then ultimately, what do I own and who do I owe? So all of these accounts go in very specific financial statements, and the first one being the income statement. It is only revenues minus expenses, period. And it's for a specific period of time. It's not a snapshot in time. It's a video, so to speak, like you're taking a moving picture of during the month. It was Joe, not Ricky. Joe repaired bicycles and earned $740. How did I see that so quickly? Because I separated it out for him on the income statement. I said, okay, Joe, your revenues came from repair fees. That's all you did this month, and you made $740 in repairs, doing repairs. And then he's going to ask, well, how much did it cost me to do that? So you say, okay, well, here were your expenses. So you've got to know exactly what expenses are. Are his supplies at this point an expense? Not in this class, because in this class, supplies are an asset. Assets do not appear on the income statement. So he paid wages, he paid rent, he paid the telephone bill, he paid utilities, and then he had some miscellaneous expenses. His total expenses were $1,001 for the month of October, for the month ending October. So Joe's going to have to make some adjustments, isn't he? If he's going to continue, because why? His expenses exceeded his revenues. What do we call that?
Net loss.
A net loss. He did not have net income. He had a net loss. So Joe lost $261 for the month of, October. Not bad if that was his first month in business. I would say that very rarely does any business in their first month, turn a profit or have net income. Okay? So then the next financial statement, remember, they have to go in a specific order because we're gonna use this information in the income statement to prepare the next one, the statement of owner's equity. And it's exactly what it sounds like. The statement of owner's equity. It's a statement that's telling our readers where our equity came from. How has it been built up? Well, he didn't have anything at the beginning of October, but what's the first thing he did? He added $15,000, didn't he? He deposited $15,000 in cash into his business. So that is a plus his investments for the month. But then he had a loss for the month, so we'd subtract that because those are owner's equity accounts. Everybody understand that? Revenues and expenses are owner's equity. They're nothing more, nothing less. So we'd subtract his net loss, and then we'll subtract, he had a $50 drawing account that we would have pulled up here from the trial balance. We had drawing right here, $50 debit. Drawing is not an asset, it's not a liability. It is an owner's equity account though. It's just not a deductible owner's equity expense. So we subtract $50 in drawing. His ending owner's equity at the end of October was $14,689. So his equity's actually gone down this month, hasn't it? So we could tell him, well, you started off with 15, but of course you're already in the hole because you lost some money on the business side and you took out a small withdrawal for the month. And then the final recap of the entire process is the balance sheet. This is where we know I have done everything correctly if what I did in the income statement and the statement of owner's equity helps us to tie to the balance sheet, because we can't do the balance sheet until we have this ending owner's equity here, which is a recap of all permanent and temporary equity. So the balance sheet is a presentation of the fundamental accounting equation. Do you see it? Assets on the left, liabilities and owner's equity on the right, and they have to be equal. So he had 3 assets by the end of October: cash, bicycle parts, and office supplies, totaling $16,789. He had accounts payable of $2,100. We pull this owner's equity from the statement of owner's equity. $14,689 plus $2,100 is $16,789. Did we do this right? Yeah. We're in balance. The balance sheet is our grand finale. And all of it, all 3 of these financial statements came from one place, and that was the trial balance. And where did the trial balance come from, though? From the general ledger. And where did the general ledger come from? The journal. So do you see how it's just, again, it's a process. It goes, starting in the journal, to the ledger, to the trial balance, then to financial statements. And if you record, or misadd, or post to the wrong account along the way, then ultimately you probably will not be able to do an imbalanced balance sheet. It's just not going to happen. Accounting is so full of checks and balances along the way. It's really remarkable, again, and I say this every semester, that it is remarkable that this particular manual system has been around literally thousands of years, and it still works perfectly every time if you follow the rules and you're a tedious enough worker to be able to do it all correctly. So again, if you're a puzzle solver, most of the puzzle solvers would make great accountants, because it's a puzzle here, big giant puzzle that you have to start with the first little pieces, and then as you start building on the pieces, they all come together. But until you seriously take it to task, to attempt it yourself, I could stand up here all day long and it's not going to help you a lot. It's just not. Accounting is definitely one of those things, kinda like a computer. You know, I always love it when, I'm having computer issues, so I have to call support on this, that, or the other, and they say, well, do this, this, and this, and I'm just like, whoa, whoa, whoa. Really, I just need you to show me on a screen so I can follow you, because we all have, even in our brain, we have muscle memory.
Exactly.
And so if you're not doing it yourself, then you're not, you may think you're getting it. It's kinda like on the computer phone call, they tell you what to do and everything, and you, kinda write yourself some notes, and yeah, I get that. I totally understand that. What's happening with me, 10 minutes later, what am I doing?
Looks unfamiliar.
I have to call them back. Sorry, that didn't work. Because that's just that we're just creatures of doing. And accounting is definitely one of those, you've got to do it. Me, again, standing up here and telling you that this has to be equal, this has to be equal, debits have to equal credits, et cetera, is not gonna solve it for you. It's just not. You've got to attempt it. And what are the best lessons you've ever learned in your life? I'll tell you what mine are in just a second. Anybody wanna share? Not, I don't mean a specific screw up you've made in your life, but what was the best lesson you ever learned? It's because you did what? You made a mistake, and you got yourself out of it. Agreed? And unfortunately, we all learn by mistakes. That's just the nature of life. And accounting is not indifferent. The best way to learn accounting is to dive into it and make mistakes. Because when you have to fix them, then you figure out what you did wrong, right? Me standing up here and telling you is not going to fix your mistakes. You've got to go and find, well, what did I do? What did I do wrong? And so that's why I'm going to email this or put it out there on Blackboard so that you'll have it. And truly make an attempt on 4B to find yourself some ledger paper, and you can get those T accounts too. I got this sheet of T's off of the internet. I just Googled T account for classroom purposes or something like that. They're everywhere. Print yourself out a couple of them and try it. It's the only way you're going to really learn it.
This 4B is a practice, or is it a?
It's an exercise at the end of your book.
Okay, within the chapter there.
Yeah, at the end of the chapter.
Okay.
It's actually, if you have a physical book, it starts on page 120. And I would think that lines up with the ebook, I'm not sure.
Probably in a box or something.
I mean, all the problems, you know, kind of look
Yeah.
at the end.
Okay.
So, they're not hard to find. They're within the chapter, and they're in the ebook as well.
And, let's see, well, how many columns, you call it a double column,
2 columns.
2 column paper, but there's actually 5 columns.
Yeah, but we're not doing that in this class.
Okay.
So. Okay, any questions? I think we're actually done for today. Y'all have, I think, if I'm not mistaken, I think you only get 1 attempt on the exam. Has anybody taken it yet to know? You get 2? Okay, so you get 2 attempts. How much easier could it be? Seriously, I mean.
I think it took me an hour, and I was like, I think I can do it better, or I can do better. So I did it again, and I only got a point better.
Yeah. Yeah, because what it does is it rotated in new questions, didn't it?
I think it gave me, yeah, new questions.
Yeah. You get 2 attempts, but not the same questions 2 times. I mean, some of them will be the same, but a lot of them will not. Okay, so have a great afternoon, and good luck. Don't wait until, 10 o'clock tomorrow night to start it if you can avoid it, because anything can happen at 10 o'clock. And I can't help you.
Blackboard has been a nightmare this week.
Yeah, I think it was down a lot this weekend, actually, last week or something. We're having some network issues or something, I guess. That is not my department, thanks, Bill.
Have a good day.
Y'all too.
Have a good one.
I have a
question, like, for this class, we have like multiple accounts payable, like, for each account, like, name. Yeah, cause I had my accounting teacher previous, and she made me like, do all of it, like, I had 3 pages of everything.
Right.
It was, I was like, I don't know, I remember it, cause I took accounting 1 and accounting 2 at the high school.
Oh,
But then I missed a year though, cause I had to like do stuff in that year.
Right, we just don't have time in this class, but typically you will have, I mean, you could have 50 accounts payables, but they'll all tie to the one.
Yeah, cause like it's a different, like, cause it's like a sole proprietorship, right, for this class. And
Uh-huh.
I think like those 2 were focused on like corporate stuff, so,
Oh.
so yeah, that's why like, I don't know. So like, it's kinda different here, that's why.
Yeah,
So I'm like trying to understand.
well, hopefully you'll get there.
Yeah, it was, I mean, I understand some basics, like the first 2 chapters, I understood it.
Yeah,
Alright.
yeah, all right, thank you.
Alright, have a good rest of your day.
You too.
Oh, by the way, I have a question, would you like being called like professor or?
Oh, just call me Vanessa.
Okay, cause, I have like some teachers, like say like professor
Oh, I
and stuff.
know.
Cause I'm trying to be like formal, cause that's what my, like I have like contact with my counselors in my high school.
Uh-huh,
So yeah, I've been trying to sound like formal with my letters, so I can't write it.
right, yeah, I'm not that formal.
Alright.
I don't think that much of myself, so.
Oh, cause some of my teachers, like in like my high school class, they were doing crazy on that one, so I had to be formal for all my classes.
Yeah.
Like I had to do handshakes, I had to like do a firm handshake.
Right.
And like my chem teacher, she had to like do this, and she'd read us like this every single day, like, she's like, why didn't you do this? I don't know.
Well,
It was crazy.
in business, that's kind of a thing, a firm handshake is,
Yeah, cause like if you do like a weak handshake, she went crazy on me, but you have to do stronger like this.
yeah,
Oh.
yeah, it's just a sign of, confidence.
Yeah, I tried doing one for a whole year, and she like, they went into accounting 2, right? She's like, there was only like 4 people in the accounting 2 class, so I mixed with the accounting 1, so she never had time for us.
Right,
It was horrible.
yeah, it is horrible. Thank you.
Alright, have a good rest of your week, afternoon.
You
okay?
too.
Ms. Robinson,
Uh-huh.
can you do me a favor and send me, you remember a couple of semesters ago, you sent me the general ledger papers and stuff that were blank?
Oh, yes,
Can you send me a
I'll do
couple
it.
of those so I can print them out for her?
yes, I'll do that right now. And
Okay, thank you so
I'll
much.
send you also this, problem that we were going over in class so that you can print it for her.
Awesome, that would be great.
Okay, thank you.
Thank you.